Hi everyone and welcome to this very exciting video. In this video, we are going to talk about different investment options, and this video will help you to learn how to make money work for you. Okay. So first of all, you should do this mental exercise. I do it all the time. You should divide your goals into two parts, right? Short-term goals and long-term goals. So why this mental exercise is important? Because short-term goals is where you cannot take too much risk. You do not have time in favor of you, so you cannot take too much risk. Example will be a young person saving up for the first home, let's say in 2 years. So a young person is saving up to buy a house in 2 years. He wants to accumulate down payment for that, and the time frame is only 2 years. Now, that person cannot take too much risk on his capital or her capital, because if something goes wrong, he will not be able to, or she will not be able to buy the house, right? So it's very important. When you have short-term goals, the focus should be on preserving capital, right? And returns is not the focus, so you should be okay with low returns. Now, if the goal is long term in nature, example, that same young person wants to plan for retirement, which is 35 years from now, then that person, the focus would be more towards growth of capital rather than preserving capital. Now that person has to stomach lot of volatility, because might be they are investing in real estate or they are investing in stock markets. Then the markets can go up and down, right? So you should be able to stomach higher volatility. So before you start framing investments and start matching investments to your goals, do this mental exercise where you divide your goals into short term and long term. Okay. Recap: short term, we don't want to take too much risk. In long term, we are okay with risk. Now, these short term goals, you can have different things that you can use for saving money for those goals. So you can start by opening a savings account. You can have GICs, you can have money market funds. So in the future slides, right, we are going to discuss about what is a savings account, what is a GIC, what is a money market fund. If you have long-term goals, then you can match those goals in or achieve those goals using different investments, like investing in real estate, investing in the stock market, buying some bonds, or giving your money or putting your money into managed products like mutual funds, ETFs, and insurance. So that's why the mental exercise is very important. Have short-term goals, try to use safer instruments to achieve them. Have long-term goals, right? Try to use growth-oriented investments to achieve them. Okay. Now, what is a savings account? So the basic mechanism of savings account is you have cash, you give it to the bank, that is, you open a savings account with a bank, and the deposited cash generates interest. Now this interest, right, gets added into your savings account, that is, the interest is compounded. So how do you understand it? Let's unpack it. I put $10,000 into a savings account. That savings account gives me 2% interest, that is $200 in the year. That $200 gets added into the savings account. So next time the interest is generated, it will be on $10,200. 10,000 original principal and 200 previously generated interest. That is, in a savings account, you generate interest on interest. Now, these savings account are low risk product, right? Because you first of all open them with a bank, and these products have CDIC insurance. CDIC insurance helps you protect your investments from bankruptcy risk. So if you open it with a bank and the bank goes bankrupt, then CDIC, which is a crown corporation, will provide you insurance up to $100,000. So if you have a savings account like let's say $80,000 and the bank goes bankrupt, then CDIC will help you recover that money. Savings accounts are very high liquid because you can access the money anytime. You can transfer money from savings account into a checking account or use it to pay the bills, etc. Important point, interest in savings account is taxable. So whatever interest you're generating, you have to pay taxes on it. Savings account are different than checking account. So there are limitations on withdrawals and transfer. If you exceed those limitations, the bank will charge you fees. So when you go to a bank, you can open a checking account or a savings account. Checking account doesn't have any interest. Savings account does have some interest, and we discussed the key highlights of a savings account. Now, a practical example just to make you understand it better. So this is an example of an online savings account. So Neo Financial, this is a Calgary based fintech company. Highlights they have given, they pay you 2.25% interest on whatever money you put. There are no annual fees and you can sign up in 3 minutes. So this is the easiest way of opening a savings account. So key features also, the important point, it is covered by CDIC. So if something happens to Neo Financials, you are covered up to $100,000. Okay, you can use interact transfers, you can set up direct deposit. So if you're working somewhere, you can ask the company to deposit your money with Neo Financials. Okay, so this is an example of online only savings account. Then you can also open savings account with different banks. So this is an example with TD. I'm not promoting TD or Neo Financials. These are just for example's sake. So they pay you 0.101% interest from $0 to $1,000, right? This is an e-save, like everyday savings account. Okay. Higher money you put, the higher interest they pay. There is e-premium savings account too, which pays a little bit higher interest. Okay, so these are examples of savings account. TD, for example, will charge you fees if you do exceed the free number of transactions that they give from savings account. So savings account are not a substitute to checking account. Checking account, you don't pay fees when you transfer money. The next product that you can use to save for your short-term goals is GIC. GIC is guaranteed investment certificates. You can open GICs with different banks. There are different types of GICs. You have cashable GICs, non-cashable GICs, and market link GICs. Now, before we discuss that, what is a GIC? GIC means you're handing your money to the bank. Bank is using that money for doing its business, and it is paying you certain interest for your money. Cashable GIC means you can access your money anytime you want. They will pay you interest that you have generated up to that date, right? Plus your principal. Non-cashable means you're blocking your money for certain time frame. Let's example will be a 3-year non-cashable GIC, right? You put your money, you block it for 3 years, they will pay you interest basis on that. The interest will be higher than cashable GICs. Market link GIC means you're giving the money to the bank. Bank is guaranteeing you principal, so you cannot lose what you have put in, right? So let's say I'm putting $10,000, I cannot lose that $10,000. Plus, they might guarantee you a certain minimum interest, and they will pay you interest based on certain stock in returns that are happening. We'll see an example, you will understand it better there. So GICs you open with banks, they are cashable, non-cashable, and market link. Cashable means you can ask for money anytime you want. Non-cashable, the money gets blocked. Market link, the interest rate is not fixed, it depends on what the stock market is doing. GIC is very low risk product. CDIC insurance is available, so up to $100,000 you're protected. Low liquidity for non-cashable GICs because your money gets blocked. Key point, interest is taxable. So even in savings account, interest is taxable, right? So whatever interest you generate, you have to pay taxes. Even in GICs, interest is taxable, but you can add these GICs into an RRSP and tax-free savings account. So this course discusses RRSP and tax-free savings account in greater details, but RRSP is where you do not pay tax right now, you pay it when you withdraw money, and TFSA, you don't have to pay tax on interest. GICs are issued by the bank. Now just to give you examples, so this is TD Bank GICs. First is cashable GIC. You put in money, you get interest. Interest, like if you put less than $10,000, you get 2.45% interest, right? You can add it in TFSA and RRSP, and whatever, like whenever you want money, you can access it. It will keep on generating interest up to that time. Then there are non-cashable GICs. You can block your money for, let's say, 18 months. They will pay you 4.6% interest. So depending on the capital, interest rates. And like the interest rate is way higher than non-cashable GICs because you're blocking your money. If you want access to money before this 18 month gets over, then you have to pay a penalty. There are also market growth GICs. Example, this is a TD Banking and Utilities GIC. They invest in banking stocks and utility stocks. You can block your money for 3 years. Minimum interest they will pay is 10%. So your capital is protected, plus they will pay you minimum 10% interest, right? For 5 years, the total interest. And you can get up to maximum 50% interest depending on how market performs. Okay. The next product, and my favorite, this is the product. This is not a recommendation, but personally I use money market funds more than GICs and savings account to save for short-term goals. So what is a money market fund? So you have cash. The cash goes to a fund manager, right? That fund manager manages your money, and in a money market fund, they invest in high interest savings account with banks, or they invest in, right, let's say government debt, short-term government debt. So money market funds are managed as an exchange traded fund or a mutual fund. The fund manager invests your money that you are giving in a high interest savings account or a government debt which is short-term in nature. These money market funds have high liquidity because whenever the stock market is open, you can sell these ETFs or mutual funds and withdraw your money back. Low risk, right? Because they're investing in savings account of banks, or they are investing in like government debt. Interest is taxable, but you can add it to your RRSP or TFSA. They are issued by mutual fund companies or ETF companies. They're not issued by banks. Banks might have some money market funds, so you can check with your bank. Now, key point, these funds do not have CDIC insurance. So like just to visualize how it works, you buy a money market fund, your fund will generate some interest, right? And whenever you want money, you sell that fund and take your money out. Now, example of that will be Horizons high interest savings ETF. This is a money market ETF. So what is its objective? To maximize monthly income while preserving capital and liquidity by investing in high interest deposit accounts with Canadian banks. So they invest, right, your money in high interest deposit accounts with Canadian banks. Interest rate is way higher than, let's say, a savings account, right, or a non-cashable GIC, or cashable GIC. The interest is 4.29% and they pay you monthly. Okay. So if you want to invest, the fund is traded at $50. So you can buy in multiples of 50. The key point, they pay you monthly and the interest rate is higher. Also, you can add these funds into your tax-free savings account. So the interest will be tax-free, or an RRSP where you get tax-deferred investments. Okay. My favorite, personally, I use this to to accumulate emergency funds and to help invest for short-term goals. Then if you're planning for long-term investments, the most of Canadians have exposure to real estate. So you can take exposure to real estate, like either buying a primary residence, an investment property, or putting your money in managed managed real estate products like REITs. So one by one, you can either buy physical property in two forms: either primary residence where you are going to stay, or an investment property which you are deriving income by renting it out. The distinction is important because primary residence in Canada is not taxed. So you buy your first house, right, or a first apartment, you are living in it, right? So whatever money you make on that apartment or that house does not have capital gain taxes in Canada as of date. That might change, so that is important. So you can get tax free growth from real estate. Okay, investment properties, you do have to pay capital gain tax, but you can generate some rental income from them. So these are physical ways of buying real estate, either a primary residence or an investment property. This course discusses real estate in great details. So do watch other videos on real estate if you're really interested. You can also invest your money in managed products. Managed products are where you give your money to a fund manager, and fund manager then buys physical real estate. You get exposure to the growth that might happen, and you get exposure to rental income. Again, if you're interested in REITs, this course has a topic of REITs and it covers it in great details. If you're saving money for long term, you can also buy stocks. Stocks are nothing but ownership in companies. So example, let's say you're buying Shopify. Shopify is a Canadian company and you want to take exposure to that. So when you buy Shopify, you become owner of Shopify, part owner of it. If Shopify does well, the stock price might grow. If the market does well, stock price might grow. So there is a possibility of capital growth, and companies might also share their revenue, share their profits with you in form of cash dividend. So when you invest in stocks, there is a possibility of even cash dividend. It is important to note that stock markets have higher volatility. So basically useful for long term, not that useful for short term goals. Okay, example will be, let's say if you go to Yahoo Finance, so something like TD. So this is a Canadian bank. If you buy this stock, you might have to pay, like, let's look at the Canadian listed one. So it's a cross listed. So this is the American market one. So this is the Canadian version. So if you buy this stock, you have to pay almost $86.91 right now to buy it. Once you get exposure to this, you are part owner of TD. Whatever TD does, you are exposed to that. So if TD does well, there is potential of this stock to grow. For example, since it has listed at $5 in 1995, it has grown up to become $96 stock. So over a period, it has gone up. So you might get potential growth from here on into the future, right, if TD does well. Along with that, you also get a dividend yield. That is, if you buy this stock, it is expected to pay you 4% of your money back in dividends you receive every year, and forward dividend right now is 4.09. So if you buy $1,000 of TD, you might get $40 in dividends, right, next year. Okay, this is an example of a stock investment. You can also buy bonds. So bond investments, so this should be bonds. Okay, so we were discussing bonds. Bonds are basically, you hand your money to the government or you hand your money to some company, and that company uses your money, government uses your money, so they pay you interest. These interests are called as coupon payments. So you have possibility of coupon. Also, based on interest rates, right, bond goes ups and down. If the interest rates go down, bonds go up. If interest rates go up, bonds go down in price, right? If you are interested, this topic, like this course also covers bonds in great detail, right? So you can listen to those videos. Bonds are somewhere in between. They're more risky than, let's say, a GIC, right? But they're less risky than real estate and stocks. So somewhere in between. You can also use managed products. If you do not want to do investments on your own, you can hand your money to someone else to manage it for you. Managed products are a way of doing that. So what happens in a managed products? You hand your money to a fund manager. Fund manager makes investment decisions, right? Whatever returns they generate after taking their fees, they provide it to you. So these fund managers can invest in stocks, bonds, real estate, or even things like cryptocurrencies. Now you can have cryptocurrency managed products. So if you want to invest in Bitcoin or like Ether or something like that, you can use managed products to do that. They can be active, right, where investment fund manager makes active investment decisions. They can be passive, where they don't make active decisions. They invest in the whole market or the whole index. There are different types like ETFs, mutual funds, and insurance linked products that you can use to manage your money. Okay, so basic idea is you hand your money to someone else, that someone else manages that money for you. So just to summarize, divide your goals first of all into short term and long term. Short term goals, your focus should be on taking low risk. You do not want to lose your principal and focusing on little bit of growth. So you can use savings account, GICs, and money market funds to do it. Personally, I use money market funds for short term goals and for my emergency fund. So it's basically combination of savings and money market. Some part is in savings account, some part is in money market funds. Long term goals, you can stomach more risk potentially, right? Markets can be volatile. If you even markets go down and you lose money, you have time to recover. So focus generally for investors in long term goals is growth. You can potentially tolerate higher volatility. Stocks, bonds, managed products can help you achieve your long term goals. So that's it for this video, right? If you are interested, right, stay in tune, stay healthy, and listen to other videos.